name is Dave. On YouTube.
Hello and welcome to the Short Vol Show Live. My name is Dave and I'm in ghost mode because I'm not all here today. Welcome viewers from far and wide. I appreciate you watching the show today, and the reason why I'm not all here today is because of my Tesla position, which has been giving me quite a headache and really just makes me not even want to do a show because I'm so just not enjoying it. I sit there and I just stare at the screen all day. Now, what's in the news? I want to start doing a little bit of a news recap during the show for everybody and just talk about some stuff that may be affecting us out there in stock market land, possibly. And one thing I found in the news today actually was an article on this Market Watch talking about how everything is going up at the same time. Gold is going up. All the stock market's rallying. Tesla is going up like crazy. And what does this all mean? And it's called an everything rally. And this is the article I was looking at here. And what does this all mean? I'm on live. There we go. Tesla Gold and the dollar soar. An everything rally has some stock market investors fearing how it all ends. I think what they really mean to say there is that the people who aren't long any of these things are frustrated that they weren't long, and so they're trying to make up some sort of doom and gloom thing about it. I've been just sitting there all day, and I just sit there and I just watch Tesla trade. And fortunately, I avoided the two big day up moves between days, which was yesterday and then I think it was like 2 days ago. I missed both of those. So because I've been pretty much shorting this a lot. And so, yeah, it's lucky I missed those. Let's see if I can get this fixed here. Lucky I missed those two big up moves. But let's take a look at a 10-day of Tesla. And, it's amazing with Tesla. Just talking about stock. The milkshake theory, I'll have to check that one out. When we talk about executing orders in a stock, we talk about different levels of being aggressive. And right here, you can see Tesla's closed, but here's just a sample market here. You can see 907, 25 bid at 908. Well, if you're just sort of average, as far as how aggressive you want to be, you might put a bid in mid-market. If you're trying to buy it, you might be 908 bid mid-market. But you can see people in these rallies just being super aggressive. So, for example, desperate to buy this thing. So if this was the market here and it was offered at 908.50, you'd see people going like 912 bid. And I sit there and I just watch this trade all day. I think it reminds me of standing in the pit. And so I sit there and I put up my time and sales on one side of the screen, which is empty right now. And I watch the blocks trade and I watch it trade. And you can see people like desperately trying to buy it, other people desperately trying to sell it. And it's very interesting to watch. The other thing that I noticed that's especially frustrating to me being short this is you see how there's like numbers here. There's like a 2. So, it shows bid for 200 supposedly. Well, now they have this new thing on Thinkorswim. On the bid side, it will show bid for 0 shares, but the 0 will be, it'll be a real bid and it will just chase the offer up. But yeah, I've been pretty frustrated, and I think the reason why it's been very difficult for me is that, I'm by nature, I like to sell options, and owning options, even though the price levels for options on Tesla have been extremely high, owning options has been working. It's been making these outsized moves. It was up almost 10% today, and 10% of a $900 stock is a big move, right? That's almost a $100 move. and it's made a few of those moves recently. So anyway, my strategy has been to try to avoid these big up moves and then lean a little bit short after the big up moves. The other strategy has been to put on very wide condors. Now, what do I mean by that? What is a condor? Well, a condor is making a bet that a stock kind of stays in between two areas. So if you've got a $900 stock, you might make a bet and say, well, I'm going to bet that it stays between $1,100 and $700, let's say. And you put that bet on. The way you put that bet on is you sell an out-of-the-money call spread. So you might go up here, up top, and sell something like out in March. Well, you can see my trades here, but you might come out in March and you might sell. I picked here the March 1,090 1,100 call spread I sold on the upside, and I'll get out of the way so you can see that. You can see it on the chart. You can see it on my thing here where I sold it. I sold the 1090 1,100 call spread up above, and below I picked the 800 790 put spread. And so if Tesla stays in between these prices, then you collect money every day. The other thing I sold is I sold some stuff that's expiring in 9 days, so pretty. And you know what? To tell you the truth, trading this stock 9 days seems like an eternity because it's made huge moves. Just look at the last 10 days. I mean, this is a 10-day chart here. Let's see. Let's get a 10-day chart going. Okay, so here's a 10-day chart, and I mean, it's made some big moves in the last 10 days. Look, it's been between 687 and 968 in 10 days. So certainly, it sounds like 10 days is a lot. I mean, it is a quick period of time, but it could move through the strikes here. So what did I do? I picked the 28 Feb expiration. I went up above the strike, and I sold the 1,110 call spread. And let's see what I sold. What price did I sell that at? I sold that at $2.12 and $1.97. So averaging around $2. Which market data subscriptions? Hey, what's up, Tom Perez? Tomas. I'm not sure exactly. I get all my information through Thinkorswim, which is it's a free service, and they are the ones themselves who deal with the market data and paying for all that. And Thinkorswim is free, and you don't even have to put any money in with them or anything. Also, if you want the quotes for UVXY market data, you can go directly to the CBOE website, and the CBO will give you that there. So you shouldn't have to pay anything right now to get that information. And we will get on to the VIX. We just had expiration, so we will get on to the VIX. Things have been kind of getting a little bit back into line as far as the VIX goes. If we take a look at VIX Central here, for example, and I'm going to pull it up right here, we can see that now we are on to March as the front month and April as the second month in VIX land. And let me get out of the way here again for a second. And you can see we are in a fairly normal state with 5% contango, and the distance between spot and the front month future is a healthy, what is it? It's $1 and it's a little over $1.10. Now that's kind of tight for right after expiration, but it's pretty normal compared with where we've been. We were very, very flat in the curve for a couple weeks, but back up to 5% contango, and these products should start moving lower. I did talk about in the most recent video how I think the bullseye strategy is a great one to have on right now, and that bullseye strategy once again is to pick out in UVXY and to sell the at the money call. So for example, right now the call that I would be looking at to sell would be the 11, either the 10.5, actually probably the 10.5 call in UVXY. So remember, for at least for Thinkorswim, you need to have at least $5,000 in your account to sell naked calls. And I don't recommend, if you're just getting into trading the VIX, that you sell naked calls. But let me explain the strategy to you anyway, just so you know what it is. All right. So what it is you would pick out, and let's say you have a $10,000 account. If you have a $10,000 account, you probably want to just sell maybe one or two of these calls. But you'd find what the at the money strike is, and at the money means closest to where the underlying is trading. So up at the top of the screen, we can see UVXY closed 1072. So it would either be the 10.5 or the 11 strike. So, and we're 9 days till expiration here. So you could sell the 10.5 strike. Now the market here is wide, 60 bid at 98, but wait till the middle of the day when it's narrower and everything's kind of calm, and sell one of these calls. And let's say you sell it at 75 cents. Then you just hang out, and that's $75 in your pocket at the end of the week if UVXY is below 10.5. If UVXY is not below 10.5, then what you do is you're going to buy this call back, and you're going to sell one for the next week. So let's just do that right now just to demonstrate. So if I was short that call, and the call was if UVXY ends up above 1050 at the end of the week, then what you would do is you would go ahead and buy this next week out call. So I'm going to click on that one, and you would sell out this one. And you wouldn't do this until the Friday before it expires. But I'm going to hit Control and click on the bid for this one, and it's going to bring up this ticket here where I'm buying the March call and I'm selling the Feb one against it. And this, you're going to collect some money when you do that. Let's see. All right. So you're going to be selling the you'd be selling the March call and buying the Feb one. So you're going to collect 16 cents to do that, and that's all more money that's going to be heading towards your pocket eventually when UVXY is below 1050. And so what you do is you sell one call, and you just wait till Friday. If the call expires out of the money and is worthless, then you just collected the money. If the call's in the money, you roll it to the next week. It's a very simple strategy, but it works long term and will give you consistent profits. And I have friends who do this. They won't just do one or two calls. They'll do a strip of calls. So, for example, they'll sell if we look at this February with 9 days to go, they might sell the 9.5, the 10, 10.5, the 11 call, one of each. Because if UVXY really goes down far, then the most you can make selling a 10.5 call is that 75 cents you sell it for. But if you'd also sold the 9 call, if UVXY really goes down far, then you could have collected that money too. But we want to make sure that we're as close to at the money as possible with what we're short, because that's the stuff that's going to have the most premium and is going to decay most rapidly. So what we're trying to do with this bullseye theory is we're trying to combine both the fact that this goes down with picking an option that has the maximum amount of decay because it's right before expiration, and we're adding those two factors together to increase your profitability. That's what we do with the bullseye strategy. Another strategy which I've employed many times would be to just wait until UVXY kind of pops up and then buy a put spread. So, for example, a put spread I might look at if UVXY were to pop up. This March is almost too close to expiration, but if UVXY were to pop next week to 15, then I would look to probably buy something like the 15-12 put spread in March. The 15-12 put spread, if you subtract the strikes, you get $4. So the most this can be worth is $4. Right now it's $2.65. So the difference between $2.65 and $4 is what you can make when UVXY comes back down after it's spiked. And once again, same thing with this spread. If UVXY stays up for an extended period of time, you could roll this spread out to the next month. And that's what we do. You have to be patient sometimes with these VIX products because it can take a little while for them to go back down. In fact, in extreme cases, it can take 6 months to a year for it to go back down. But in most cases, it just goes down all the time and you just collect your money. But you want to be aware that it cannot work out the way you expected. And anybody who's traded for any period of time will know that things that can go wrong do go wrong. So plan for things going wrong and you won't be caught by surprise. So I wanted to tell a story about breaking in to a pit. People seem to be interested in stuff to do with working on the trading floor, and I was a trader on the trading floor in Chicago, and there were something like 50 different pits there. And what a pit is a spot where people commit to trading specific stocks. So generally the way it worked in Chicago was you, as a trader, you're going to go stand in some spot. And each pit has like somewhere between 5 and 20 stocks. And so generally, if it's a big company, they'll have a trader in many pits. So if you've got 50 traders, you can have one in each pit. Most bigger firms would have a trader in the big indices. On the SIBO, there was the NASDAQ index, the SPX, and earlier there was the OEX. And so they would have a trader in the big indices, and then they would have traders in the individual pits. Now, sometimes companies would have a combined portfolio where they were like trading, they were using the trades from all their traders in all the different pits as one big portfolio and hedging against each other and things like that. A company that used to do that was called Timber Hill, and their traders would they had a computer, the computer would tell them what to do, and they would just do it. They didn't really think for themselves. They just did what the computer told them. And we would trade with these guys all the time. They would do trades that seemed nonsensical to us standing there because they would give up what appeared to us to be giving up edge to trade with us. But I'm not going to question why someone wants to trade with me if they want to trade on my markets. I mean, I am going to be curious about it, and if it's a big player, I might get frightened. But if somebody's going to make little trades with me and pay my offer or hit my bid, I'm glad to trade with them. And Timber Hill was like that. But anyway, so what would happen is once we were trained as an options trader, we'd have to go and pick a pit where we were going to stand. And whatever stocks were in that pit would be the ones we traded. And it was usually a hodgepodge of different stocks. Like, it wasn't like, oh, that pit has all technology stocks or that pit has all gold mines. It would be a hodgepodge of stocks because the way that stocks got assigned to pits is they would just go through the list. And, when it was your pit's turn, you'd get whatever stock was next. And so it kind of just went around and around in circles. And each pit had a company that was kind of sort of responsible for it. It was known as a DPM system, and it's kind of a hybrid between a specialist system and just equal between everybody. By that I mean, like, for example, the New York Stock Exchange traditionally was a specialist system. What that means is that one trading company is assigned to, say, AT&T stock, and they are responsible for operating the book for that stock and making the trade. That has changed nowadays because everything's gone electronic, and so several people will make up the market. But back then, the SIBO had DPMs, designated pit managers, I think it standed for, that ran each pit. And they got a bigger percentage than everybody else, and they hire a broker that stands there. So basically, it'd be a bunch of us traders. There'd be a broker that was designated to that pit he would get the orders and he would yell them out. And trading for us was in what's called open outcry. What that means is that you have to yell your bids and your offers out, and whoever has the best bid or offer gets to trade. And so, it's interesting here. We'll trade an option. We'll click something on a screen. Well, there, what happens is a broker will come in and he'll say something like Tesla, March 900 calls, and we'll yell at the market, $50 bid at 52. And if he's a buyer and my offer is the best, my at 52 is the best, then he'll trade. Then it's to me to trade. To sell as many as I want to him. And if someone says pay 52 and that's my offer, if I say sold, that means I'm selling as many as he has to buy. So you don't really want to say sold. You want to say how many you'll sell them, because if you say sold and he has 1,000 to buy, then you're going to be stuck with 1,000. Now, in practice, it doesn't really work that way in the end, because we all kind of know each other after a while, and a broker's going to know kind of if you're a big player or not. And if he's got all these to buy, he's going to know. But, open outcry, it's a whole different dynamic to the trading game. You're not just sitting in front of a screen and you get to pick and click like with your mouse. You have to stand there. You have to be fast. And if it's a spread or something, you're going to have to look up the screen and do the math in your head to, if there's a spread, he wants the UVXY March 15-12 call spread. There's nothing, the screen just shows the bids and offers for the different options. So you've got to do in your head, okay, well, the put is $2 bid at $2.50 and the other put is $3 bid at $3.50. So, so I'll pay $1 for the spread. I'll sell it at $1.50, something like that. You have to do the math yourself. And so what we'd have to do is practice. I come in on Saturdays and I would do fractions times tables, because when I started trading, options were in fractions. They were in 16ths, eighths, quarters, halves, and you had to be able to do the math quickly in your head, because if you couldn't be the first one to give a market, then you weren't going to make money for your family. So all these dynamics, we had to learn how to trade options. It wasn't just learning, point and click on a mouse. It was having to do math. It's pretty basic math, but to be able to do math very quickly, to stand there and focus in on what you need to focus in without getting blinders on your eyes, so you're keeping track of what else is going on in the market, but focusing in on the screens and being able to make markets. And, when you first start out there, you're coming in against all these professionals who have been doing this for years, and if you can't hang with them, you're not going to be able to to be successful. So it's a big challenge breaking into a pit. And I'm going to share more about that next time, because I've gone too long already. But I'm going to talk about breaking into the Xilinx pit. And this, I guess, is just an intro, but we'll do the next chapter next time on the Short Vol Show Live. So, yeah, today was better in Tesla for me. But, it's scary out there. I have my Delta. My Greeks are very mellow right about now. If we look at my Greeks here, well, that's certainly not right. My Delta is like short 2 deltas or something. I mean, I'm very, very close to being completely flat. The only way I lose money is if we really move a whole lot. Here, you can see my Greeks, actually. I'm short 3 deltas here, down up 10%. I'm short 15 deltas. So what that means is that when it says short 3 deltas, what that means is that each dollar that Tesla moves up, I lose $3. Okay, so that doesn't sound like a lot, but if it moves up 100, then I lose 300. And each dollar it moves down, I make $3. And this chart here kind of shows This isn't right. It's got some example trades in here. But this chart shows, where I make the most money or lose it. And you can see clearly on this chart illustrates, as long as Tesla stays between like 820 and 1,000, I do great. And, my plan is to trade this during the hours and kind of adjust as we move around. So this is my position going into tomorrow, but this could readily change by the end of the trading day tomorrow. So there you have it. I like to get a little bit more into why I'm choosing certain trades on Tesla and what I'm doing minute by minute. Maybe we'll do a little bit of that, more of that tomorrow too. And you know what I really want to start doing is I want to start giving information on like kind of what's going on in the financial markets every day and kind of update you on what major developments are happening in the trading world a little bit more, and help you keep on track, on top of that sort of thing, which should help you out. Let's see. Hey, Dave, instead of the put spread, would you be long with puts only? Well, the problem with being long with puts only is that they're so expensive. I mean, if you want to buy one put in Tesla, like the at the money puts are like $50 each or something like that. And maybe you're talking about UVXY as well. Well, also with UVXY, I don't like just being long puts because every day I feel like time is kind of working against me if I'm just long puts, because every day that nothing happens, which is 2 days, remember 2 days a week are weekend days where nothing trades. Every day that nothing happens, you're losing money. So I would prefer with a put spread, you have a direction, but one put is kind of offsetting the other. So I like spreads much better than being long options. I feel that in general, now this is just a generalization, but in general, options are just slightly mispriced to be more expensive than they should be. And part of that is due to the fact, well, if you think about it rationally, there's more people who are willing to buy options than sell them, right? Especially retail people. You're told as a retail person that that you shouldn't sell options, right? And many accounts won't let you sell options, just like yours is, Fabio. It won't let you sell options. So that's why options are a little bit mispriced. Well, what I would recommend, if you are unable to actually execute put spreads as trades, there's some other things you can do. And one of them is you could trade an inverse product. So, for example, you could look at SVXY. I don't know if it allows you to sell. Does it allow you to sell calls? Maybe it doesn't allow you to sell calls either. But you could put a trade on in SVXY where you are buying a call spread. Now, remember, SVXY moves up over time, whereas the rest of these move down. And, I have the same problem in my... how about selling for? Yeah, that's an option. That's an option, Ed. I would suggest. I mean, you're kind of doing you're kind of doing two things at once with that. You certainly could do that. That's kind of constructing a risk reversal, right? Selling out of the money call spreads to buy puts. We would call that a risk reversal. And one of the problems with doing that is that because of the nature of the skew in UVXY, the out of the money calls are skewed lower. So what that means essentially is like you don't get great prices for selling out of the money call spreads in UVXY because of the risk that stuff will move higher. If you're selling a call spread, the call that you're selling is going to have a lower volatility than the call that you're buying due to the skew. So, for example, if I pull up the UVXY chart here, I can see if I can illustrate that for you. If you pull up UVXY and I put this on implied volatility so we can see what volatility these options are. It's not super pronounced here, the skew, but let's look at like March options. You can see, if you look on the far left here, you can see as we move up in strike, so for example here at the money is 10, right? As we move up in strike, the volatility of the options moves higher. So it's showing that at the money, the 11 call is a 106 vol, whereas the 28 call is a 160 vol. So when you sell a call spread, you're selling like a cheaper volatility. Like if you sold the 11 call at 106 volatility, and then you're buying the more expensive volatility. So what we'd say is, because of the skew, this is skewed to the upside, which means that the higher you go with a strike, the higher the implied volatility. So because of the skew, it tends to collapse the value of call spreads. So you don't get all that much money from selling call spreads in this. Yes, it could help finance buying some puts, but my suggestion would be just sell some call spreads and be done with it. Forget buying puts. Just sell some call spreads. And you know, for me, I see call spreads. Buying a put spread is the same thing to me as selling a call spread. They're two sides of the same coin. If you think about the way options pricing works, if we look here at the March 9/11 call spread and the March 9/11 put spread, basically those two trades together, another way of looking at it is you're buying the 9 combo and you're selling the 11 combo. So you're buying the 9 call and selling the 9 put, and then you're selling the 11 call and buying the 11 put. So basically you're buying synthetic stock in the 11 strike and you're selling it in the 9 strike. It's all part of what's called a box, and essentially if you sell the March 9/11 call spread for $3, you are synthetically buying the put spread. I'm sorry, it's a $2 spread. So if you sell it for $1.50, the 9/11 spread, you're synthetically buying the put spread for 50 cents. Yeah, Fabio, I would, a lot of people have that issue, and it's very common that people aren't able to trade some of this stuff in their IRA or TFSA accounts. And excuse me. A solution for a lot of people in the past was to buy something like XIV while XIV still existed, or buy SVXY. And essentially, buying SVXY is shorting volatility. And yes, it's only 0.5 leverage, but in a sense, that's a good thing because people tend to over commit. They put too much money into these products as it is, and so having it less leverage, I think, will keep people out of trouble a little bit more. And yeah, that's a pretty common thing. But yeah, I generally, in my mind, I would rather just sell call spreads and maybe roll the strikes down a little bit lower in strikes than sell the call spread to buy a put. What's the preferred way to hedge a long call? Well, we did this thing before where we're talking about like what is the best trade against what's the best trade against buying a call? And the best trade against buying a call is selling that same call out for a higher price, of course. I guess it would depend, William, on what you're trading, what you wanted to do, and what was out there. For me, being a market maker, I would set my markets in such a way that I would wait for somebody to come in with a trade that fit to hedge my call. In general, as a market maker, what I would do is if I sell if I buy a long call, I would just go out and sell stock against it in whatever delta it was. So, for example, if I bought 10 at the money calls, I would just go and sell 500 shares against them. An at the money call is like a 50 delta call. So if you bought 10, you probably sell 500 shares against them. Now, obviously, with the UVXY, it's a hard to borrow stock, and so it's not going to be as easy to sell stuff against. But and also, it depends where the call is. If you're buying a call in a stock, like let's say the stock's $40 and you're buying the 70 calls, right? That's what we call a saw. If the stock is $50 and you're buying the 70 or 80 call, that's a way out of the money call, and what we would call that is a soft delta call. And by that I mean that, like, if you buy the 70 call and you hedge it, and your sheets tell you, okay, well, I need to sell 30 shares of stock against that call. If you sell stock at against that call to flatten out, and the stock slowly moves up towards the strike, you're going to get killed because wherever you sold the stock, you're going to lose money as it goes up because you're short that stock, and the call's price isn't going to move. So you really want to be careful how you're hedging stuff based on which strike it is. And I know that's a little bit of an evasive answer, but it would vary for a situation how I would want to hedge something. I mean, if you're talking about a very deep call, if stock's 50 and you're talking about the 25 call, I would pretty much consider that call to be the same as stock. And I would hedge it accordingly. But if you're talking about a way out of the money call, many times if I buy way out of the money calls, I would under hedge them because, like I said, if the stock walks up to the call, you're going to get killed. And yeah, that's kind of the way that works. Anyways, thanks for all your questions, guys, today, and thanks for checking in. And I will see you next time on the Short Vol Show Live. Thanks for tuning in.
You're watching Famous Dave.